What's up, everyone? It's Eric with Option Edge, and today I want to talk about how implied volatility and earnings events, how that affects the pricing of different options. Okay, so let's go ahead and take a look. Got a little slideshow here. So implied volatilities and earning events. So earning events, companies announce earnings every quarter, so 4 times a year. They give us a snapshot of the company's business, what their fundamentals are, how much revenue they're making, their profit, their cost of goods sold, earnings per share, et cetera. So, and they'll also give us future guidance about where they think the company, how much more revenue they'll make in the next year or next quarter. So there's usually before earnings, there's a lot of uncertainty. We don't know how well the company did in that last quarter. We don't know what they're going to do in the future, what they're going to announce. Maybe, for example, like Tesla, they announced that they have some new a Tesla truck now and things like that. So there's always a lot of uncertainty around earnings, okay? And when there's uncertainty, that increases the implied volatility prior to earnings, okay? So usually with all earnings events, implied volatility rises. There's other things that can also make that implied volatility rise. So FDA clinical trials results for drug companies would rise, or some big announcement. We know that a CEO is going to announce something big that would also increase the volatility of a stock. And then some SPAC mergers. We recently saw CCIV got merged into LCID, Lucid. And there was a lot of volatility around that event. Okay, so those are also like earnings events. So okay, how can you play this? You can actually. So for example, Fastly had earnings. It's a very volatile stock on its own. And there's been a lot of mixed expectations. There's been very high expectations for this stock, and there's also been very low expectations. So basically, the combination of that type of those thoughts make this stock's earnings makes the implied volatility of the stock very high. So one of the trades I did is I put on a strangle, and I put on a 35. I sold a 35 put and sold a $60 call. My credit, so here's the credit, $1.40 and $1. And I put these both around the 16 delta. And the reason why I put these around the 16 delta is because that's right where one standard deviation move is. And this is something that the guys at Tasty Trade like to do. So I use the September 17th options for this. So in one day, the next day, so for example, before earnings, these contracts I sold for $2.40. Next day, I bought back for a 38% gain at $1.74. So that just shows you how simply after the earnings, the volatility of the stock goes down. And when the volatility goes down, the pricing of the options go down. So if you're a seller of options, then you can buy back cheaper and make a profit. And here's something from Tasty Trade. Going into earnings, the market will price in an implied move for the underlying. As earnings approach, the market will constantly price the options to that implied move, which will pump the implied volatility in the earnings cycle as the number of days in the cycle decreases. This is just saying that volatility increases as we get closer and closer to the day of earnings. And yeah, that's basically more or less than after earnings. So yeah, after earnings, there's less mystery about the stock. So that's why we know the financials now. We know the profit, the revenue. There's fresh information to evaluate the stock price. And what happens is, and I mentioned this, is implied volatility decreases, and we get a crush in volatility, or a vol crush. So some people actually can make a lot of money just selling around earnings, and something I've been doing more and more now of. And here's again Fastly. So this is Fastly's implied volatility before earnings. So you can see the IV is 86.9. Okay, and then this is implied. This is Fastly after earnings. Okay, So now you can see that it was up here, dropped down here, and now that we're at 68.8. So if you were to sell options, you could have made a decent amount of money if you if you sold them at the right price. And that's it basically. That's how implied volatility affects how earnings affect implied volatility. Peace out. Hope you liked it.